Okay, good afternoon, everyone. It is almost 4 p.m. and we are ready to start our live weekly market review. If you are joining us here today, I'm grateful for you and thank you for joining us here with Akeelah Traders. And we're going to get started here very quickly with our live market review. And so let me say, okay, it's right at 4 o'clock. So thank you all for joining. We're going to start. I'm Demetrius. I'm with Akeelah Traders and Akeelah Trading Academy. And so in today's weekly review, we've been taking time to go through and just look at the market structure on several different assets. And today we're going to be looking at a couple of different things. We're going to take a look at Apple today. Apple had a very exciting week. They had earnings that was reported earlier this week. So we're going to take a look at how things shifted with Apple, what kind of moves were being made. We're going to take a look at NVIDIA, Broadcom, the NASDAQ, and Eli Lilly. So that's a couple of different things. But the goal that we're trying to accomplish with these weekly market reviews is to go through and just show you that there's a structured way that we teach and follow here at Akeelah that is designed to help us find high probability trade opportunities in the market. So that's not to be confused with guaranteed. You know, we're never guaranteeing that these are going to be the market plays that are going to work out, but it's high probability opportunities. And so we use a very structured system that we've learned over the years and have applied in hundreds, if not thousands, of different trade opportunities. And so that's what we're going to review in today's review. So let's jump in. Let's start with NVIDIA, since I already have this NVIDIA chart pulled up. So the thing I want to go to with NVIDIA, so as I'm going through this, I'm talking about how do we create this structure? How do we identify these opportunities to start with? So this all started with NVIDIA. I'm on the daily chart here. Our primary way of looking at things is to stay on the higher time frames. So whether you're trading stocks, you're just buying stocks on your own, whether you're trading options, whether you're trading futures or whatever, our recommendation is to stay at least at the 4-hour time frame and higher. The lower time frames just present a lot of noise. Are there opportunities there? Absolutely. There's tons of opportunities for day traders and scalpers to get in and make those small moves. But when it comes to a structural standpoint, we want to define the fact that the overall market structure is usually created and is going to be more stable on this higher time frame. So let's go back here to NVIDIA. We're going to go back to this time period. Let's just say a couple of months ago, because this is where the current trade that we're in now. So NVIDIA, this is again the daily chart here. So the way we would identify these kind of opportunities, you'll see back around this time here of the first part of May, NVIDIA had a pretty good pullback, and we just went on just a tear. This time from the first part of May all the way up through maybe mid-May, the NVIDIA price went from around 195 all the way up to 230, 236, almost 240 is what it hit. So at that time, the way we look at it is we're looking at where are market makers establishing a footprint. So we have a very detailed way of looking at the charts, of looking at candles to see not just bull candles and bear candles, but how those candles were formed. So we have a very unique way of identifying zones that are going to be the high probability zones. And so at that time, the daily zone up here on NVIDIA was back around this 195 to 200 area. So that just tells me the market took off in a very strong high direction, but it left a lot of imbalance down here. And so we were able to zoom in on the 4-hour chart. I think that's where we actually created our trade. Is the lowest time frame we're going to go down is the 4-hour. So if I go back to the 4-hour around this time, again, when a market makes a high or it pushes up, we want to identify where is the last demand zone. So in our system, we start with a high and then we look back to see where is that critical area of market demand, true demand, not fake demands. It's not based on volume. It's based on structurally looking at, how the footprint of this market was made. And so we had bear candles back here. We saw some bear pushes. This is what, May 14th. Back here again around May 13th. And so, but these don't qualify for us. So these pushes back, and I know people have a lot of different ways of looking at the market. They have their way of doing it. We have our way. But our way would help me identified that these bear candles, just because the market made bear candles back here, that did not create a demand zone for me. So our definition of demand zones is an area or a range of prices where the market makers have already told me that there's a high desire to buy this asset. And so to me, when we go back and look at it through our system, we would have identified this zone area as the 4-hour demand zone. So as long as NVIDIA stays pushing, the market keeps pushing up and it stays above this demand zone, I'm good. I would expect it to pull back to here, hold this area and continue to push up. That would be a bullish trend that would continue. But and if we see a break of structure, so I define a break of structure as a market close on the relevant time frame that I'm speaking about. So I'm on the 4-hour now. So if I get a 4-hour candle that closes below here, that tells me with a pretty high degree of certainty that NVIDIA is not going up anymore. Not that it's not going up ever, but that the current trend, the current push that it's making right now, the market has to do some rebalancing. So let's fast forward and see, when did that happen? That happened back here. So the first time we got a 4-hour candle to close below that was here on May 22nd. So at that time on May 22nd, I'm going back to live time, to what it would have been live then. At that time on May 22nd, the way we read and teach you to learn to read these markets, we can identify this and say, this is a structural break on the 4-hour time frame. Once I see a structural break like this, I can, from then, see that the market is intending to fall. Now, it doesn't mean they're going to fall immediately. So we have a couple of different ways to say, well, what do you look for? Two different things that we look for is for the market to either retest the zone that was broken. In this case, this is this 4-hour demand zone. I'm looking for it to retest this area right in here and fail to break above it. If it does that and continues to reject, that's the first sign of a pretty strong rejection. And that happens occasionally in the market. The most likely case that we see is because this market has been pushing up so strongly and so fast and so high, that usually when structure is broken, the market makers, or usually the large money movers in here, will most of the time, I'll just leave it that way, exhibit a fake out move. Now, a fake out move is designed to capture these sellers who are thinking, hey, this area here broke, it's really going to sell. So they're most likely to pull a fake out move, but where's it going to fake back out? So we identify at the time we see a structural break, we're able to identify through our methodology of looking at it, that this is an area of high probability here. How we drew that specific area, that's a little more detailed of exactly what you're looking for. But we find this high probability area here to say, once I see a structural break like this, most likely NVIDIA is going to pull back up into this area and reject. If it pulls back up into this area and rejects, that's confirmation that this initial structural break that I saw was valid. So to summarize, structural break doesn't mean it's automatically going to start going down. It says that's the first signal that it's going to take a dive. So I look at this, I expect to see a pullback to this yellow area. I see a pullback to that yellow area, I'm going to execute a sell on NVIDIA. Now, I'm going to walk through the next steps of that. Where is it going to go? Where am I anticipating that it's going to fall? Once I see this break like this, I'm expecting it to fall back to what I call the source of this. The source would be, I would zoom out to see, where did this move start? Not just the very last, impulsive move up, but where is the stronger base of where this move started? So I'm looking for things on either that current time frame. If it's 4-hour, I kind of give a little credence to the 4-hour. I mentioned 4 hours is as low as we want to go. The strongest ones is the daily and the weekly. So if I see something like this on the 4-hour, I'm expecting it to pull back. One, I'm expecting it to pull back up here. And if it does, to reject. And my target is going to be back down either to the source, what I would call the 4-hour source, or I would go to a higher time frame, in this case, which would be the daily. I would go to the daily and say, where is my daily support for that? The daily demand zone I already have identified. So at this point in time, back on May 22nd, when NVIDIA closed at 217, I could say, based on our way of structurally reading this, I've got a high probability trade opportunity that NVIDIA is going to pull back up to the 230 to 238 range. And when it does, it's going to sell. And it's going to keep selling until it comes to at least back to $200, 195 to 200. That's a trade. I can set that trade up. I don't know exactly when it's going to do it. So is it going to be tomorrow? Is it going to be 2 weeks from now? I don't know, but I can set a pending sell up here. If I trade, I mostly trade CFDs. So we're trading, I can put in a short at a, specific area and have a pending there. If you're trading options, you can wait until the market, you're definitely going to want to wait until the market pushes back up into this area. But when we see things like this, like we did, look at this. So this strong push back up, and I want you to see exactly where it wicked. And I didn't draw this yellow box here after I saw where the wick was. We do this consistently over and over and over, apply it to every asset, every trade that we look at. So it's a systematic way of doing it. I'm just showing you how there's no coincidence that the market came exactly to this 232 with this rejection. So if I was doing options, for example, then I would have been waiting for this push up. Once I got to this range, I'm watching the options chain. I'm looking to see shorts or I'm looking for puts. And again, I don't know the time frame. So that's where options get a little tricky. You don't know when it's going to play. So you're going to have to either push out a couple of weeks or you're going to have to wait till you get these high probability areas and take these short, 1 day, 2 day expiry options that are out of the money. And all you're playing is you're not playing for it to get there. You're looking for it to make a significant move. And so, but this is where my short would be. And you notice we came right to this area. Now let's see, where did NVIDIA fall? It fell back down exactly to this daily demand zone area. So that's my first, that would have been a successful trade target. If we put this on a, where's my long and short position, it would have looked something like this. Now, if I'm taking this short, my stop has to be, I always have to assume that I could be wrong. So my invalidation point for this is I'm expecting it to push up here, but I cannot have NVIDIA come back up here and close above this area. So my stop loss needs to be somewhere up in this range. It could wick, but as long as it doesn't close above this, then that sell that we saw, which was triggered by a break of structure back here and a push back up, that structure is still valid until the market closes back above, about 238. No close, I'm not changing that structure. So my stop loss has got to be up here though. So let's do that. Put our stop loss here. And then at that time, my take profit could have been bring it to here. That's where I'm going. That represents I don't know if you folks can see that, but let me zoom in a little bit. That represents if you can't see that number, that's a 3.88. So almost a 1-to-4 trade opportunity. That says I risked $1,000 for the potential of making $4,000 on that trade. Or if your account's smaller, risk 100. If I'm wrong, I'm going to lose $100. If I'm right, I'm going to make $400. So 1-to-4 almost trade opportunity. So now, once NVIDIA did that, we say this area here, am I looking for it to automatically start buying here? No, I'm not. I'm not saying it's guaranteed to buy from there. But when it comes here, I'm going to reassess. There's other things that we are able to look at to see what happens when you get within a demand area. What are you looking for signals that the market is truly ready to reverse? In this particular case on NVIDIA, we had lower areas identified below here and said there's a higher probability that once we get to this demand zone, that it could come down to this daily fair value gap area. And this was around 190 to 191. We got a near perfect fill on that around June 29th or so. The market pushed back up, came back down again on July 29th. So this has been several months we've been following this. So the roadmap we laid out for NVIDIA is to wait, sell it up here, trade it down. Once we get into this area, this is where we want to start accumulating. So our plan was get down to this area. And now you start buying NVIDIA because long term, NVIDIA is still bullish. You go to the weekly, monthly time frames, it's still bullish, but we don't want to be buying it at $220, $230. Even if you're an accumulator or you're an investor and you're saying, well, hey, I'm buying for the long term, these are the kind of opportunities where you have to get out of the market with a reason to do so. Get out of the market, capture a pullback, you load back in down in these areas. So that's what we're seeing play out right now on NVIDIA. So I'm going to go back up to the daily because we're still, this overall structure is still not completed. It's saying this was a good time to accumulate, but I want you to see these areas below here. We came very, very close to the bottom of this fair value gap area that I was expecting to hold. And so it did hold. So I'm good. I'm good. We're holding it. This is going to continue to push up. But right now we have a daily supply zone, which was part of the structure that was formed on this move down. So I'm not expecting NVIDIA to push just to blow through this. I expect to see resistance here. So when we get back up to 214, 215 area, it's likely that NVIDIA could push back down here again before continuing to go up. So I want to have a good understanding of where my trade could go from that. But that's all based on seeing the structure, following it the way that we look at. So I don't know if there's anyone that is watching us live right now. If you have any comments or questions or anything, please drop it in the chat. I would love to answer your questions or discuss those things with you. But I'm going to move to a couple of other ones. So let me just point out, we do immediately after this live stream, I will have a Zoom Q&A where we'll be able to interact a lot more. It's free, doesn't cost you anything. You just have to register to get the link for that. You can do that by going to our website. It is just tradingacademy.akeelah.io. If you come here, you can see information about our Trading Academy and just say register for free here and put your information and stuff in there, and it'll give you the link to the Zoom call that we'll have immediately after this. And again, it'll be a lot more interactive, and we can talk through things and get your questions. Okay. So that's NVIDIA. That's the first one I wanted to take a look at. The next one I want to jump to is Eli Lilly. And so let's go to Eli Lilly. And so Eli Lilly, I want to look at this one. This is one we've been watching for a while. And there's been some things going on with Eli Lilly. For one thing, they're scheduled to report earnings tomorrow morning before the market opens. So before 9:30 a.m., they're going to report earnings. So I want to take a look at what we've been following with Eli Lilly. And so for this one, I'm going to go to TradingView, I'm inside of TradingView, but I'm going to go to our posts. If you get an opportunity, I would encourage you to take a look at some of our posts within TradingView. On TradingView, our channel is Akeelah Traders. And I'm trying to get to my post here because I want to show you what we saw at the time on Eli Lilly. So you can follow us here, ask questions, leave comments and things like that. But let's go and look at, because I want to emphasize the structural way we're looking at this and how what we just saw on NVIDIA, the same thing applied on Eli Lilly. So Eli Lilly, I'm going to come to, let's see, where's the first one we did? Fake don't break. I'm looking for it. Okay, right here. So Eli Lilly. So this was a post we did on Eli Lilly back on June 30th. At the time, the price was around $12.11. So I'm going to show you how exactly we identified the same structural process I'm talking about. At that time, we were looking at the hourly chart. Hourly at that time only because the 4-hour structure hadn't developed to the point of showing this. But I use this as an example to say the process that we're using, the methodology we're using to read the market applies on every time frame. I just have to know if I'm looking at a 1-hour time frame, I can't treat that as bond. I can't say, well, that's absolutely what's going to happen because it's not a high enough time frame to be void of some of the noise, but I can still use it. So here's what happened on Eli Lilly. Using this same process that we used before, this was the highs. We had a high that had peaked out around June 29th. It got as high as around 1238, almost 1240. So from that time on, I could go back using the structural way we look at this and find where is my demand zone. My demand zone was this area right in here, not up here at the top. And we did have bear candles back in here, but those were not my area of concern. This was my demand zone that I found, according to the way we look at the markets. So I was able to identify when we got a close below this on June 29th. Hey guys, this is a structural break on Eli Lilly, And again, not saying that's the end of the world, but it says this pump that's continuing up, up, up. We're not going up anymore. Not now, not until we see a rebalance and we're able to account for some of these voids that have been left below. So same process. At this point in time, when I was able to draw this structural break, I was immediately able to identify where's the source of that. The source is back up here. Like we just saw on NVIDIA, I expect the market to pull back into this area and then sell. Where's it going to sell? Once it does that, well, I come down to find where's my source. My areas identified down here. I may have to go to the higher time frame to see this, but here it is here. This demand source was somewhere between 1115 and 1125. So this is where when Eli Lilly was sitting around $1,200 or so, $1,220, I said, I'm expecting this just going to follow the structure. I can be wrong. I may be wrong. That's fine. I'm willing to be wrong. I'll take the loss when I see that. But at that time, I'm saying here, my sell position is if I see it pull back up into here, I'm going to take a sell here. I'm going to sell it if and when it comes to 1227. I'm going to put my stop loss up above this area here, which is like 1237, 1239, 1240. So I'm talking about, $13 stop loss or something. Well, let's use around them. Let's say approximately 1230 up to 1240 or so. So anywhere from $10 to $12, $13 stop loss. That's it. My reward is going to be, I'm taking this baby all the way down to here. And this is a structural way of doing it. So I expect there's going to be noise. There's going to be, maybe it pulls down here. Maybe it pushes back up here. I'm not going to get out of that trade. I'm not getting out of that trade until it's invalidated. And it is invalidated when you close back above here. So let me go to the live Eli Lilly chart. And we're going to see how, I can play it from here to see how that played out. It just plays it so fast in TradingView, right? So we can see that we pushed up here several times. And this is very, very interesting because this is one of these cases where I'm going to drag this. Hopefully let me pull this up. I'm going to have to go to the live chart just so. Okay. So let's go back to Eli Lilly. This was the hourly. So I want you to see how once we identified this area back here, how many times did the market fight, y'all? How many times did it fight to try to get by there? This was the break that we saw back here. So we expected to push up into this area. While this was going on, the H4 actually produced the same structure. So I saw it once on the hourly, right? Once I saw it on the hourly, I'm also able to see the same thing on the 4 hour. So let's go to the 4 hour because that's going to be important as to why the market did push up higher than we were expecting. Let's go where it is here. Okay, 4 hour. All right. Same thing on the 4 hour. So once we had this market on the hourly, it had pushed up a little bit. It broke structure, pushed up and fell back down. During that fall down, we had a 4 hour break of structure. And that happened over here around mid-July. So as I mentioned to you before, this is why I stay on the 4 hour and above. The 4 hour gives me a pretty credible market structure. So same process. We have these highs up in here. I identify where my 4 hour demand zone is. 4 hour demand zone was in this area. Once I see a structural break, look what happens. I'm able to identify the source of that. Again, similar area. The top of that was a little bit higher because on the 4 hour time frame, the market made a higher high. but my yellow zone is still the same. I expect it to pull back into this area and drop. Where's it going? Target is still the same area. The 4-hour source overlapped with the hourly source. So my trade opportunity there was, I'm going to lay it out like I did on NVIDIA, short. I'm going to take a short. Now, we never know exactly where within this range is going to go. I'm expecting it to come to this range. I couldn't tell you whether it's going to come exactly to the bottom or the middle or the top or whatever. So my risk, I have to adjust it accordingly. So let's assume worst case that I would have set my entry at the bottom of this zone. Entry at the bottom, stop loss has to be at the top. It's got to be above it. And my take profit target is going to be, I'm going to take this down until it comes to this H4 source area, which is, let's see, that looks like from 1090 to 1115. So where's that? That's right here. Okay. Now the ratio for that, what is that? That is a 2.7. So pretty close to a 1-to-3. Again, I'm risking $100. If I'm wrong, I'm going to lose my $100 or my $1,000. If I'm right, I'm going to win either $270 or $2,700. Almost 1-to-3 ratio. That's pretty good. That's what I want to follow. All right. So, and you can see as of today, this is exactly where Eli Lilly came. At least as of now, it has come to this area. It hit the full target. We're still not completely done with Eli Lilly, because what we could do is potentially see the market fall a little bit further. It could fall down into this deeper area. So we're saying as of now, this is my initial target. If we show support and the market shows that it's valid, is ready to bounce up out of there, that's where I will go. Okay. All right. So that's how we ended up with Eli Lilly. We followed the same plan. We didn't get shaken out by, the market moving up and faking out and those kinds of things. We're able to hold it through a lot of the noise and end up in a good place. All right. Now, the next one we're going to take a look at, and I think this is probably going to be, maybe this is going to be my last one. I don't want to take a lot of time here. And I don't see many folks on here asking questions, so I'm gonna try to be productive here. Let's take a look at maybe either Broadcom or NASDAQ. Let's take a look at Apple. Let's take a look at Apple. I don't think I have Apple saved on here, because Apple was one of these that was very interesting, and it was interesting to see what has gone on with Apple since their earnings. And so I'm going to stay on the higher time frame with this one, and it'll be daily. So let's look at Apple here on the daily. And for the daily time frame, we're going to see why I thought that Apple made this significant pullback when we had earnings. And so this is one of the charts that we have not had a overall break that we were looking for, but we'll see how we got to where we were. Okay. So as of right now, Apple made its high back here around July 29th at the end of July. At that time, the demand zone was this area in here. So this is down below 322 to 329. So this is the current daily demand zone of this. So when Apple pushed up this high, I'm just looking for the market to pull back to this demand zone. So this is one I have not had a structural break. So if there's no structural break, then I don't expect the market to fall. I'm not looking for Apple, to fall unless and until we get a break below here. All right. But now if you go a little closer, I'm going to zoom in to, so this is the daily that we're looking at. I'm going to go to the weekly time frame and say this is the overall reason why I believe Apple made the move down that it did, is because on the weekly time frame, look where my weekly demand zone is. The weekly demand zone for this was between 275 and 302. So even though Apple had pushed as high as 330, 340, 345, this was preferred. This is the calendar here, or the candle here before the earnings, but we had pushed this high. But look how far overextended we are behind this demand zone. Markets don't continue to do that. They're not just going to push up and up and up and up and up and keep going. So we saw a pullback right here to this. I was expecting the market to pull back at least to this 302, 275 to 302 area. It fell right down to here. And people were kind of wondering, well, what happened with Apple? It had great earnings, and why did it fall like this? Well, it fell. I'm going to go down to maybe the 4 hour to see the kind of fall it had, folks. The fall it had was a pretty substantial fall. But why did it fall? And why did it fall to here? It's because the weekly is saying there's a demand. The weekly demand is there's institutional buyers ready to buy Apple here at 275 to 300. They're not trying to buy it at 340. So the institutions or large cap funds that have the hundreds of billions of dollars, they're not paying 340, 345, 350 for Apple. They're saying our demand is down here. So we just needed to wait and see it to pull down to this area of demand. And so now that it's down here, the only thing that's intrigued me about this is during the process of going down to this area, Apple had a daily break of structure. So if I would leave it with at least this chart with this, the concern that I have right now is that one, let's say on the bullish side, Apple is still holding this weekly demand zone. As long as we hold this 275 to 302, you're still bullish. You could pull down, push down into this area, consolidate down in this area, bounce back and forth, that's fine. But we need to hold this area. From the daily standpoint, though, because now we have broken this daily demand zone. This was our demand zone for Apple. Once we close below this, which was the close that we had after the earnings, the post-earnings fall, once we close below this, it makes me go to and say the same structural thing that we've seen over and over and over now could be playing out again with Apple. You broke below this, most likely you'll pull back up to this supply source area and confirm the fall. Or it could push back up, and this is the case I have here, it could push back up and retest this daily demand zone that was broken. Either way, seeing bullish activity on Apple coming out of this weekly demand zone is nothing unusual. You should expect it to bounce up out of this area. How much it's going to bounce, how far it's going to bounce, it's going to be dependent on these zones here. So it's either going to push up, retest this daily demand zone, or if it pushes through, come back to this supply source, it could fall further. If it does, a break of a daily structure still brings it to the weekly. It brings it to the next higher time frame. So that's why I'm pretty strong in saying, hey, Apple, we just need you to hold within this daily demand zone range. Okay. All right. We can move to the next one. I think I got time to do one more review before I jump to our live Zoom call. If you're following on here, if you're online and you have a question or something, please leave it in the chat, leave a comment or something. I'll be glad to answer that question right now. Or I'll remind you, you can join us as soon as we end this live stream, which will be in the next few minutes. We're going to jump on Zoom and just have a live Zoom review. And that's really more of an open discussion if there's anybody available that wants to talk about the market other than myself. And to do that, you just have to go to our site, tradingacademy.akeelah.io. That's our site. You just have to go here and register for the free Zoom class. It's free. We're not going to be chasing you down, soliciting you for information or whatever. You just have to register to get the link for the Zoom class. But you'll be able to join us on here and ask questions, make comments. We'll be able to have more live dialogue about those kinds of things that you may be interested in asking about. Okay. So let's go back, and one last one that we're going to review today, and that's going to be the NASDAQ. I want to look at the NASDAQ because the overall market these last couple of days has been smoking. And so I want to look at some things we've done on the NASDAQ and to show how we've been following this market structure here pretty much the same way as we've done everything else. I'm going to start on the daily for this particular one. So this is my daily look on the NASDAQ. Back here around, this is around the first part of June, we had a high on NASDAQ. I was expecting NASDAQ. This was the daily demand zone at that time. So we usually start at the high, go back to see where's the last structural demand, which is not going to be the same as if you just Google demand zones or get on YouTube and start looking for what's a demand zone. Our way of looking at it is not going to be that way. We're going to have a more unique way of identifying the correct demand zone. But this was our demand zone area, drawn in blue here. So if you notice here at that time, and our demand zone was drawn after we made this high. So as of May 25th, this was already my demand zone. So when the market continued to push up, up, and up away from that, I'm expecting I'm not going to chase the NASDAQ. Yes, it's getting higher. It's getting higher. I hear it. I hear all the excitement, but your demand is down here, buddy. When you come back down to here, that's when I'll be interested in buying the NASDAQ. I'm not going to chase it. Get the QQQ. Some people are trading that, right? You're going to wait to demand. We want to identify the proper institutional demand zone and wait for the market to come back to that. So notice how the market did come back, and I don't remember off the top of my head right now what happened this day. It was something crazy, something big, whatever. But we should have already known that it was coming here. Why it came there is completely irrelevant to me. I just want to know that you're coming to this area. And as long as you hold above 28.6, then the NASDAQ is still bullish. So that's what happened here. It came here, pushed back up. That's all fine and dandy. But the problem came when we came to June 10th. On June 10th, we got a close below this daily demand zone. So a close below the daily demand zone, to me, triggers a break of structure. I note that as a daily break of structure. So this is what our chart looked like as of that day. I highlight this and say that's a daily break of structure. I want to identify where's the source of that. My source of that is this yellow area up here. How exactly we identify that zone, that's a little more strategic and more detailed than we can cover right here. But we identify this zone. So when I see that break, it says I expect the NASDAQ. It showed me one that I want to go down. I'm not ready to continue making new highs. I'm ready to go down. But before I do that, I'm most likely going to pull back into this area for a trap, a fake, a sucker's move, whatever you want to call it. I want to entice buyers to come back into this area. And when I do, it's only for the purpose of capturing people to sell. And so I'm expecting it to come to this area and sell. Now, where am I expecting it to go? That's why here I put in a short opportunity here, right at this zone. I want to short the NASDAQ. My stop loss needs to be above this zone. I don't want to have it so close that a small wick is going to take me out. So push it up significantly above this zone. And for my target, if I see a daily break of structure and pulls back to this source, I'm expecting this to come down to my daily source. That's the same time frame I'm looking at. The daily. I want to see daily, where did all of this start? And I see right now, I've got a significant high probability area down here, identified a daily fair value gap area down here between 26, just say 26.3 and 26.9. Okay. This is where the NASDAQ should be going. If I see what I just saw here. So patiently, we wait for it. When it comes here, we can take that short, and my take profit target can be down to this area. Let's see what kind of a ratio that is. That's a 1-to-4. I mentioned it several times already. I could risk $100 on that trade. If I win it, I'm going to make $400, or risk 1,000, make 4,000. 10,000, 40,000, whatever the size of your account is, you scale it appropriately. But this is what I'm calling a high probability trade, folks. We're looking for high probability opportunities. So let's see what happened to the NASDAQ. It did indeed push back up to here. It did not come above. So we were safe, still in this trade. And now we wait for the fall. We wait for it to fall, fake out, continue to push back up, to entice people to think it's buying, but it's not ready to buy until it comes back down and satisfies these lower areas. And so in this case, we came, I say, within a hair's breadth of our full take profit target. We were expecting it to get to 26,920, and it came to 2709. So it came within $100 of that. Very solid, strong structural move for the NASDAQ. So the move that we're seeing right now, fast forward to today, we're pushing back up. we're pushing back up here. Why are we pushing back up? Because we came down. And in my opinion, personally, we still did not sufficiently satisfy this, but it may have been we covered enough of it, but the true trade is, so maybe we didn't get a 1 to 4, you got a 1 to 3.5 or something. And there's some signs up in here that could have given us an opportunity that, hey, it's ready to start pushing back up. But I would still say this, I'm going to leave this live weekly review with this comment, with this perspective on the NASDAQ. Structurally, from a structural standpoint, this is still in this bearish structure. Yes, it's pushing up. It is smoked, absolutely smoked $2,500 in the last couple of days from these lows. So it is pushing up, but my resistance area, we're back up here. This source is still resistance. So the NASDAQ is still playing this daily break of structure, push back up and come down until it comes to fill this fair value gap area here, or come to what would be the source area of that down here at 24.5. Until that happens, this bear structure is in place. The only thing to invalidate that is the NASDAQ is going to have to come up and take out this source. It's going to have to come back up, and fortunately or unfortunately, whichever way you look at it, that means we're going to have to recover and make a new high. You're going to have to take this out, because now this is the general that's making the decision, the command to say, I said fall. And the market fell, and it didn't come quite to where he said, I told us to march until we come to here. It didn't do that. So it's pushing back up, in my opinion, as one more opportunity to say, can we break this out? It could happen, may not happen. And what our position is here at Akeelah is, we're not trying to project, we're not trying to predict, we're trying to read and react. So as of right now, the NASDAQ has pushed up. Look like today's close is going to be back above this daily demand zone. If we close back above here, that's good. That's a good sign. It's positive. But it's still not bullish, because this daily structure is in place. So I wouldn't be surprised to see the NASDAQ, and I'm not, again, predicting, but I'm just saying, projecting based on what we've looked at. I wouldn't be surprised to see us come back and retest this broken demand zone here again. Back down here to retest, and then try to have strength to come in here, because there are a huge number, folks, I mean a huge number of high volume, high dollar sellers waiting to dump the NASDAQ when it pushes up back into this area. So if it is going to continue bullish and we make new highs, you got to have a lot of strength. You're not coming all the way from down here and pushing back up and break through this area. We need to see some pullback here, get some more strength, pull more buyers and volume, and then to come into this area and possibly do something like that and then break above. That's if it's going to break above. But otherwise, I expect it to push up here, get rejected, come back down, and continue to play out this daily structure that's already in place. Okay. All right. So that's going to be it for our live weekly review here. I didn't see any questions in the chat, but I appreciate you all joining us here. If you are available, I'm going to switch over to our live Zoom Q&A. If you want to join us with that, one more time, you can come to, it's free. It is on, come to our site, tradingacademy.akeelah.io. Just do the register for free. As soon as you put your information in there, email, it'll send you the link to join us in the Zoom class. And I will see you there in about 3 minutes if you're ready to join us there. Okay. All right. Thanks again. I'm greatly appreciative for you guys joining us here on our Akeelah Traders channel. Please like our channel, subscribe to it, leave us some comments or questions, and have a blessed day. I will see you guys next time. Thanks.